All right. Well, I appreciate you taking some time out of your day. My name is Clark Engel with Everhart Advisors, and welcome to our monthly university program. Today is focused on creating income in retirement. So basically, you work your whole life, you earn a paycheck, you're saving money, and now you just have to flip the switch and start spending that money. And that can be a little bit difficult just from a strategy standpoint, but also from a mental standpoint to shift that thinking in your head. So we'll talk through all of that today. Hopefully provide some valuable information for you. So let's jump right in. One of the main questions you should be asking yourself for retirement is, will you outlive your income or will your income outlive you? So ideally, our income will outlive us. One of the worst case scenarios in retirement is that you blow through all of your investments by the time you're 80 and you're still in strong health. And now you're just living off of Social Security, or you need family to support you financially, or you have to go back to work. Who wants to go back to work when they're 80 years old? That's not really practical. So our income needs to outlive us. In order for that to be the case, then our income needs to be growing at least at the same rate that our cost of living is going up. So inflation, unfortunately, does not magically go away when you retire. Your cost of living will continue to increase with grocery prices or rent or property taxes, utilities, gas, all these things that what are impacting us pretty heavily at the moment, I would say, um, will likely continue to go up. So we need an income stream that is going up as well. A fixed income really can't be the answer because of this increased cost of living. So you might be in a situation where those first few years of retirement, you're bringing in more every month than what you're spending, and that's great. But there's probably going to be a point that you will hit during retirement where these lines are going to cross like you see here. So if you're living on a fixed income and it's not increasing, but everything that you need to buy to support yourself in retirement is getting more expensive, then at some point that fixed income's probably not going to be enough. So as an example, let's say you are needing $8,000 a month to live on. This is just your total spending in retirement for year one. Okay. Well, inflation, CPI, we'll talk about that here in a little bit, but inflation has basically averaged 2.9% a year over the last 100 years. All right. So if we assume a 2.9% rate moving forward, that $8,000 a month in year one would really turn into a need of about $9,200 in year five. By year 20, you would need over $14,000 a month just to live the same lifestyle, buy all the same stuff. By year 30, you're looking at 19,000 a month. So that's kind of, you know, scary numbers to think about, which is why we want to bring it up today. Your average retirement these days is 20 plus years, I would say. If you have a healthy couple retiring at age 65, there's a 50% chance that one of you is going to live until you're 90 years old. So that's a 25-year retirement with cost of living continuing to go up. So, the big question is, where do we find this kind of rising income? So I said, we're retiring. There's no longer a paycheck. Uh, where's this rising income coming from? And the answer is owning companies, not necessarily lending to them. So this is where we're talking about investing your money. Stocks, bonds, and cash are kind of your three major asset classes that you can participate in. Cash would be lowest risk, lowest return opportunity. Stocks is where you're getting that ownership of companies where you would have a higher risk level for higher return, at least historically, and bonds would sit in between the two. But the key that I'm going to talk through is we still want you to own companies, participate in being a stock, shareholder during your retirement, because that is one of the most reliable ways that people have outpaced inflation and just made their money last for them over their lifetime. So, um, talk through that today. So let's go back to 1960. So we're looking over the last, what would that be, 60, 65 years. This data is through the end of 2025. And we're going to reference some numbers of the S&P 500. So that's an index. It is made up of the 500 largest companies in the US. So it's a good gauge for the overall stock market. This consumer price index is that CPI I mentioned earlier. That is an inflation metric. Okay. So since 1960, the cost of living has is basically 11 times higher today than what it was in 1960. Just the cash dividend of the stock market is up 40 times. So this is just, the small amount of profit that you get paid out to you from the companies that you own. That's gone up 40 times over those 60 plus years. The actual price of the stock market has gone up 118 times. So you're comparing an increase of, inflation being, it's basically 11 times more expensive to live today, but the stock market has gone up by 118 times. So, it's kind of funny to see that the price of the index or just the price of the market was 58 in 1960. Now, at the end of 2025, the S&P was sitting a little over 6,800. Now it's well over 7,000 at the moment. So, um, you know, hugely outpaced inflation over those 60 plus years. So we want to be a participant in that, of course. Not that you need to be not that 100% of your money or your investments needs to be in ownership of companies because there is some short-term risk to that. It's a bumpy ride, right? If you've tuned into one of these before, we talk about all the time, we cannot predict the market, but if you look historically, it's been a bumpy ride. We see recessions, we see a ton of events in our economy, even happening now, that negatively affect the price of stocks. But you're going to see in some examples here that these companies that you own are resilient. They figure out how to adapt, innovate, increase their profitability over time to drive the market up and up. So this is a big point that I want you to get out of the session today. How do you calculate your number? So your number is how much money do I need to be able to retire? All right. Most people do not know this number. But it's an important one because if you've got a goal of most people retire in their 60s, 65 is probably the average age. But if you want to retire as soon as possible and be comfortable, you need to know how much money you need in your 401k or just investments as a whole, right? So how do we calculate this number? A couple steps. One is figure out basically the income that you need to replace. So your average retiree needs to replace about 70% of their gross income, I would say. So maybe in this example, let's say we've got a household that's earning $200,000 gross per year before taxes. They need to replace $150,000. That would be replacing 75% of their income. So they need 150 a year in retirement. Then you're going to subtract out your Social Security benefit. So this couple is receiving 50,000 a year. That leaves them with $100,000 per year that they need to draw from their investments. We're going to divide that by 0.05 to get to our retirement number. So why are we dividing by 0.05? That's following something that we use called the 5% withdrawal rule. Um, Simply stated, you are withdrawing 5% of your total balance every year. All right. Maybe you've heard of like the 4% withdrawal rule before. We're comfortable with five. If you're invested in a moderate portfolio, so 50 to 60% of your money in stocks and the rest in bonds, there's actually never been a 30-year period of time where you're in a moderate allocation like that where you've run out of money if you're drawing 5%. So we're talking about 20 or 30 years in retirement, we would be very confident that a 5% withdrawal rate is going to make your money last. Okay. So that's why we take 100,000 and we divide it by 0.05 because that tells us what's the actual invested amount that we need to be able to draw that 5% at $100,000. All right. So if you let's say you needed $100,000 a year to live on in this same example, and you're still receiving 50,000 from Social Security, then you've got a gap of just 50,000 that you need to replace with the investments. Divide that by 0.05, that would be 1 million. Okay, so run this for yourself. If you've never looked at your Social Security benefit, you can create an account at ssa.gov. I've done it myself. Relatively easy to set that up. You can view your benefit statement, but that's a big chunk of income for most people in retirement. So see what you're expecting. Try to get an understanding of what your spending might look like, because what you need is entirely dependent on what you're going to be spending. All right, but that's a relatively simple way you can calculate what's my number. And once you hit that number, you're in good shape to retire. All right, so the idea here is that in this example, you would be withdrawing $100,000 in that first year from your $2 million balance. But then we need to keep up with cost of living, right? So your Social Security benefit has a cost of living adjustment tied to it. So it's going to go up a little each year. We want to build that into your investments as well. So if you start at a 5% withdrawal, what that allows you to do is increase those withdrawals every year, or some people do it every 2 or 3 years, just to keep up with cost of living. So by year 5, that might look like 112,000, 115,000, somewhere in that range. All right, so move to some practical steps here, and I'm going to talk through really 6 items. Hopefully paint a clear picture for you. You know, really my goal is maybe 2 to 3 takeaways you can try to implement, think about for your own retirement picture. So we always encourage people to build a balance sheet for themselves. This is a snapshot of your financial picture. So your assets would be everything that you own of value, and your liabilities is your debt. That's money that you owe to someone else, like the bank. All right, so common assets would be cash, investment accounts, property, businesses, cars, and then debt would be, mortgage, car loan, student loan, things like that. Okay, so if you just take your asset minus your liability, that gives you your net worth, and pretty much everybody has a goal of increasing that net worth over time. This is a really useful tool, I would say, just to build this balance sheet. I update my family's balance sheet once a month, and it takes me 20 minutes once a month to just go through and update these numbers, and it's kind of fun to see if it's moving up or down. Obviously, want it to move up over the long term, but it also gives me an idea: are we budgeting correctly? How are our investments growing? Are we paying off our debt? Things like that. All right. So you can actually run a retirement projection for yourself. So a minute ago, we looked at what's my retirement number? What do I need? But then you could also run a projection to say, am I on track to hit that number, right? So what you want to do here is just determine the current value of your investments. So this would really be any money that you're planning to use as income in retirement. So your 401k, any retirement accounts you've got like that, maybe a brokerage account would be the main ones. Determine how much you're saving every year, how much you're contributing to those accounts. What do you expect your annual return to be? And then you're going to run what we call a time value of money calculation. And that can be done just by searching for, an online retirement calculator. You could Google that, and there's plenty that will pop up. Using a pretty basic one is fine. This would be a great reason to reach out to myself or our team to run this for you. I do this every day for folks. We'll be happy to help you figure out if you're on track for retirement. But yeah, you're just saying, what do I have currently? What am I contributing? How much is going to grow by? And then what am I on track to have? So an example here is we've got John and Jane. They're going to retire in 10 years. They currently have $500,000 invested. They're going to save 30K a year and they're invested aggressively. So they're expecting to get 10% return. Well, they would be on track if you ran that retirement calculation to have $1.775 million at age 65. All right. So if we go back and look at this example of somebody's need, let's say this applies to John and Jane, they really need $2 million at retirement to be able to withdraw 100,000 a year with their Social Security benefit, then they're going to be a little short, right? They're at 1,775,000. So they will either need to save more money over the next 10 years, increase their savings rate, or they may be looking at pushing back their retirement or spending less money in retirement. So those last two things are not very fun, right? We'd rather see you plan well now, increase your savings rate slowly over time, try to get more money into the market versus having to delay your retirement or spend less than what you're hoping. All right, so how should we invest? We're encouraging you to be owners of companies, which is what you typically refer to as the stock market versus lending to those companies, which would be a bondholder. So we break this out into different buckets. There's 6 buckets here that we target. And, it goes from bucket 1 being most conservative to bucket 6 being most aggressive. Most people are probably staying within buckets 1 through 5. Bucket 6 is what we would consider illiquid investments. So that just means you don't have immediate access to that money. So this would be like if you own a business or real estate, or you're in, private equity deal, there's potential for massive returns, but there's also a risk of losing everything, right? So buckets 1 through 5 are typically what people hold inside their 401k or their more traditional investment accounts. One, would be something like entirely bonds. So lower risk, but also lower expected return in that 2 to 4% range. The nice thing about something like a bucket 1 with bonds is the longest it's ever taken you to recover your money is 4 years. So as long as you can hold money in the bond space for at least 4 years, historically you've never had a loss. But it is that smaller return. As you go out into buckets 2 through 5, we get into our ownership of companies. So you can see the types of companies that you own and how that affects your expected return. The nice thing about moving into ownership is at the very bottom row there, you can see there's uh, potential to double your investment much quicker than if you're lending to companies. So it might take you 20 plus years to just double your money if you're a lender to these companies, whereas you could double it in 10 years or less if you're an owner of these companies. Now, the risk, as I mentioned, is that it's going to be a bumpier ride, bigger swings up and down in your account balance. But if you have time, then often that makes a lot of sense. And for example, you know, owning companies through stocks, historically, you've earned 10 to 11% if you've just owned the broad stock market, owned a lot of different companies in the US and international economy. Uh, Lending to companies with bonds, you've averaged probably 5 to 6% a year. And sitting in a cash vehicle like a money market or a CD, you're probably averaging 2 to 3% a year. So net out inflation, right? To get your real return on investment. If I'm earning 2% a year on a cash product and inflation's going up by 3% every year, what's my actual return? It's -1, right? I'm not even keeping up with inflation. It's surpassing me. My purchasing power is going down. Versus if that real return gets a little bit better when you're sitting in bonds, but ownership or stocks is where it really um, you really see great potential there with probably 7 to 8% real return historically.
Your screen. The lady called me.
Hold on a second, everybody.
There's no way.
Somebody's telling me you cannot see my screen. Um, can somebody put in the chat whether they can see my screen or not? Somebody able to access the chat and see, let me know if you can see my screen okay. And we got a couple of raised hands, which is probably a good sign. Bunch of raised hands. I think we're okay. Okay. All right. Sorry, everybody. It may have just been may have just been one person that let us know they couldn't see the screen, but perfect. Okay. All right. You can see the screen. Great. That would have been a disaster. All right. Thanks, everybody. Um, let's see. So now we are, okay, I was on this model portfolio slide. Get my train of thought back here. So off of these buckets, you're typically investing your money into some sort of model, like a strategy to your investment. So like I mentioned, um, it's not common for retirees to have 100% of their investments sitting in stocks. This would be like an aggressive model where everything is in these, stock ownership buckets of 3, 4, and 5. Um, that is typically reserved for folks that have more than 10 years until they plan to retire because you need some time, right? If, you can see those big swings when you own these companies. So you want to have time to recover from a recession or a big drop in the market. So typically, as you get closer to this retirement point, you're going to start to reduce your risk. And that just means typically you're selling off some of that stock exposure and you're buying into some bonds. All right. So kind of how we talk about strategy and how a lot of companies would talk about it is aggressive. You're probably looking 90 to 100% of your money sitting in ownership in stocks. If you get toward like a moderate strategy, you're probably more in that 50 to 60% ownership through stocks range. Conservative, we would say you're looking more at 20% in stocks and a high percentage in bonds. So this would also be something to talk through with us. I can ask you some questions on your time frame for retirement, um, which accounts you plan to pull from when, and give you some guidance as to how aggressive you should be. All right. So we're going to completely change gears to the mental side of things, which, I've been in the business for 10 years, and this is just more and more prevalent. You want to be responsible with your money, of course, but I have more conversations with clients about they have a hard time actually spending their money when they do retire. One, because there's that mental shift of I've been a saver for 40 years and now I'm going to be a spender of this money, which is a little scary. But also, they're thinking, this is what I've got to last me that 20 or 30 years. So I don't want to use it too quickly, or there's typically some market anxiety there. What if we see a recession? Like, am I still going to be okay for retirement? So let's talk through that. Using John and Jane in our example here, let's look at three bear markets that they experienced during their life so far. So a bear market is similar to a recession. This would be, I guess, technically at least a 20% decline from peak to trough. So shortly after they were born, you had almost a 2-year stretch here from 1973 to 74 where the stock market was down 48%. All right. So GDP was down, the economy was shrinking, inflation was high, unemployment was high, oil prices were high, okay? And you had Watergate going on with President Nixon. So, not a great time for the US economy. Then, as a lot of you are probably familiar with, lived through on the call, we had the dot-com bubble. So, this was about a 2-year period where the broad stock market was down 49%, but tech companies were down about 75%. Okay, so imagine the anxiety there, seeing positions that you hold going down by 75%. This was right around 9/11. You had Enron go out of business. This was a major public company a lot of people owned in their retirement accounts. The market cut in half basically over a couple of years. And then you had a similar market decline in '07, '08, '09, but a totally different scenario. This was the global financial crisis, where you had Lehman Brothers and other banks collapsing, biggest recession since the Great Depression in late 20s, and just huge layoffs. This one really hurt. This one really took some time for the market to recover. This was one of the longer recessions that we've seen. So, man, John and Jane, they've been through it over their lifetime, right? They had three separate times where the stock market basically cut in half. Like, what could there be a worse time to be born to try and make money through ownership of companies, right? Well, so they were born in 1970. So the cost of living today is 8 times higher than what it was in 1970. The dividend of the S&P 500, like we looked at, that small amount of profit that gets paid out to you, that went up by 25 times. The earnings are just the overall profitability of these US companies increased by 49 times, and the price of the index was up 74 times. So we just saw you had three of the most traumatic events that have ever occurred, or periods of time, I guess, that have ever occurred in the US economy, and most negative effect on the US stock market. Still over that, was that 55-year period, cost of living's up 8 times, but you would have, um, your investments would have been 74, grown by 74 times, um, just with the price of the index there. So pretty incredible stuff. We've seen a really strong bull market here, really ever since 2009 at the end of that recession. It's been a while since we've seen a drawn out recession like that. We've seen some shorter blips like with COVID and tariff concerns last year. Right now we've got, Iran conflict and the oil prices are up. It's always something a little different, right? Or at least it feels like it. But the successful investor blocks out that noise. They do not change their investments based on, you know, news headlines or uh, financial media that's talking about a dooming recession. Somebody's always talking about, a dooming recession, right? They were saying that 10 years ago, and look what's happened in the stock market over the last 10 plus years. So we want to stay invested through the good and the bad. That's what a successful investor does for retirement. You don't have to be able to time this or, you know, have insider information or know something that others don't to do well. It's just saving 10 to 15% of your income, investing it well and sticking with that. So, and to go back to just ownership of these companies being so successful for people, one, you know, a lot of these public US businesses, they have, they put out products or services that we use maybe every day or at least every month or every year. Think about, you know, everyone goes to the grocery store. I mean, not everyone, but most people use Amazon or they have an Apple product like their phone or their computer, or they stay at a hotel like a Marriott. You go to Wendy's. I just got some random examples on here, but like there are hundreds of millions of Americans that use these companies' products and services every day. And wouldn't you want to also participate in the growth of those companies? If you're going to use their product, don't you want to benefit from that company increasing its own profit? Well, that you do that by purchasing a stock, by being an owner in these companies, as these companies have an incentive to grow, right? We live in a capitalistic society and it's a competitive market. They have incentive to innovate, adapt, put out, new products, new services. When we see a recession, sure, there's some companies that will go out of business, like an Enron, Lehman Brothers, and that's why you want your money spread out across hundreds, if not thousands, of companies. But most of these companies will figure out how to change their business model and come out of it for the better. And there's also new companies that get formed out of recession, right? So it's so powerful just being invested in these US companies and hopefully you want to be an owner in these companies that you purchase product and services from. So last couple things here, and then I'll open it up to questions. So very important that you retire to something, not away from something. So if you are if your goal of retirement is just so you can get away from your job, that typically doesn't lead to the happiest retirement. You want to be looking forward to something, right? So, you need to have a purpose. We use this acronym of pushes, tends to age well. So purpose, using your time to do some sort of work you enjoy or helping others. You socialize, practice healthy behaviors, express gratitude, focus on strengths and abilities. So, maybe a little corny, but honestly, really important. Even when I'm working with clients, I can definitely tell the difference between somebody who still has passion and purpose and they're excited about their retirement and what they're doing versus somebody that just wanted to get out of their job and you know, they're not really satisfied after a few months away from it. Okay, and then just continue to monitor and plan. So life events still happen during retirement. You might have grandchildren, healthcare is going to be a big cost. You're thinking about leaving money behind. um, just talk with us. You know, we're here as a resource. We've got our Dublin, Dayton offices in Ohio. We've got our Fort Myers office in Florida. So feel free to come into the office, schedule time with us. We can meet virtually if that's easier for you. But you know, if you're a participant in one of our retirement plans, this is a part of the service on your plan is that we'll have a consult with you and talk through your specific financial situation and give you guidance. So would be happy to do that. Our next session is on estate planning. So we will bring in an estate planning attorney to talk through this. Honestly, this is part of a financial plan that a lot of people put on the back burner. And if you never get this done, then your heirs typically have a pretty big problem on their hands, trying to settle your estate and deal with probate and the cost and time of that. So this would be a very valuable session to tune into, kind of get the highlights of what goes into an estate plan and potentially look to put that in place yourself. So I'm going to open it up to some questions. I'll stay on and as long as needed. It looks like people have uh, located this Q&A chat. So there's two chats. Um, please use the Q&A chat here to type in questions that you have. Go ahead and do that, and I'll start reading through these. If you need to jump off, that's fine. Really appreciate your time this morning. Hopefully you found it beneficial, and please reach out with questions. But I will start going through some of these. All right, so we do have a question here. If market downturns on average last less than 3 years, wouldn't maintaining enough cash and bonds for at least 3 years be conservative enough with the rest of your portfolio in more aggressive vehicles for someone approaching retirement? That's a great thought. Yeah, um, there's consensus in the industry that can be a smart approach for retirement. You're exactly right. I couldn't explain it much better myself. Yeah, you know, yeah, average downturn probably is around that 2 to 3 year time frame. So if you have enough, we would call it like a war chest. If you have enough cash for call it 2 years of living expenses, then when the stock market's down, you just start using that war chest of cash and you leave your investments to stay in the market so you can, you know, participate in the recovery there as well. So that's a great thought. How do we determine which companies are best for investing if I am in the age group of 60 plus years? So that's a great question. I would say the types of companies that you own does not necessarily change just based on your age. It's more so your age would determine the percentage of stocks versus bonds that make up your investment strategy. So because, you know, whether you're 25 years old or 65 years old, the types of stocks that you own should probably be about the same. That's why I won't get into it in depth today, but that's why you typically invest through funds instead of having to go out and choose all the individual stocks yourself. So if you're in a 401k plan, you might use like a target date fund, which does all the work for you. If you've heard the phrase like diversifying your money, that means you're gonna spread your money out across the whole economy. You're going to own thousands of individual companies. So even as a 60-year-old, you'd want to have that diversification through funds, but it might just mean that I'm not owning companies with 100% of my investment. I'm doing it with 60%, and the other 40% is sitting in, bonds. Someone asked, I'm very far behind in savings and I'm approaching 60. Is there a chance that I will ever have enough? I've had to borrow from my 401k to survive. Yeah, I mean, I would encourage you to still start now, try to get aggressive now. It's only going to help you, right? You may not be in a position to retire at 65, but there may be time to still have a nice retirement. If you feel like you're way behind and you're 60, um, you are limited with the amount of time you have, and that's one of the biggest factors. But I would say, put together that budget, figure out, hey, what can I cut back on? And how much money do I have every month that I can just be putting right into my 401k or other investment account? It's just about getting that started immediately, and doing it consistently. If you've got 10 years until 70, you could sock away a bunch of money. You could get that invested and growing for you. And depending on what you're saving, you could still have pretty substantial asset by the time you're late 60s or 70. Another question for a different associate interested in retirement projection that was mentioned earlier in the presentation. How to get started on it with Everhart. I would just scan this QR code for my calendar that's on the screen, and you could schedule a meeting with myself. This should take you to my calendar, 30-minute appointments, and you are welcome to set it up that way. Stock market since 1960 or 1970, clearly way, way better than inflation. How does last 10 years look? Is there any forecasts that foresee a scenario where there's a big shift slash drop in the historical average return in the future? Um, we really don't get into forecasting or trying to predict what the market's going to do. It's a dangerous game to play, right? Because if you're not if you're not participating in owning companies, you're basically betting against what's happened for the last 100+ years, which is that stocks have averaged about 10%. There's been 10-year stretches where they've averaged higher than that and lower than that, but history would tell us that we should expect 10% moving forward. But it's all about time horizon, right? If you're looking at rolling 30-year periods of time, then those returns are very close around the 10% range. If you're looking at year by year returns, it's going to be up 30%, down 25, flat, up 10, like it's all over the place, right? Um, but you bring up a good point with inflation, like that's why we're doing it, right? We're owning these companies to outpace inflation by a considerable margin. That's what really grows wealth. Even more so important in the 1970s, I would say, because you're looking at sky high inflation. If you're in cash or bonds at that point, you're definitely um, falling behind with inflation. So another question in retirement, what's the better rollover of my 401k, traditional or Roth? My home is paid off and I only have taxes. I really don't know without talking with you specifically. It's a good question. So it sounds like you may already be close to retirement. If that's the case, then you're already pretty much set with what you have pre-tax versus Roth. So if you've got pre-tax money, it just means that you're going to pay taxes on it when you take the withdrawals. If it's Roth, then that is tax-free coming to you in retirement. Um, Whether it makes sense to do any sort of conversion or if you still have time to contribute, which one you should do, I would need to talk to you and ask some questions kind of to be able to give you guidance. So, is there a fee or a charge for retirement projection help? No, that's a free service. Just use my calendar here and should have plenty of open time slots over the next couple of weeks. And I do that all the time. So we can pretty easily just run a projection and see if you're on track, and then I can give you some suggestions to get you on track if you're not. Great questions, everybody. You're welcome. All right. Any other questions? I'm not able to unmute, so please just use the Q&A chat. You do have one. Somebody asked for my calendar. It's this QR code on the screen. Just if you scan it with the camera on your phone, it's going to take you directly to my personal calendar. Okay, well, I don't see any other questions, so I will jump off. Hopefully this was beneficial information for you. I really appreciate your time, and I hope you all have a great day. Have a great Tuesday. I'll answer this one question that just came in. I have an old 401k from a former employer that was rolled into an IRA. Should I roll that over to my current 401k or leave it be? Really just depends on how it's invested and what the fees are. So if you want to send me a statement for that IRA, I can take a look at it. The answer is it depends. Um, but I could look at that statement and tell you what makes sense. All right. Thanks, everybody. Have a good one.